The clock reads 3:15 a.m. on a Sunday. You are watching a digital screen in a quiet, darkened room. Every few seconds, the balance increases by a fraction of a cent. There are no stock tickers moving. The world is asleep. No banks are open. No wire transfers are in transit. Yet a multi-million-dollar pool of capital is earning sovereign U.S. government yield in real time. It is completely decoupled from the traditional banking system. A quiet class of ultra-wealthy family offices and institutional funds are withdrawing billions from traditional commercial banks. The first clue lies in a silent migration. While retail depositors chase 4% yields in high-yield savings accounts, institutional capital is quietly leaving bank deposit accounts. The math is simple. If you hold more than $250,000 in a bank, you are an unsecured creditor to a highly leveraged commercial entity. To avoid this risk, wealthy allocators historically used money market funds. But those funds come with a major catch: legacy rails. The friction becomes clear on a Friday afternoon. This is the structural flaw of the traditional financial system: latency. If a major banking crisis happens on a Friday, your capital is locked in a money market fund or a U.S. Treasury bill until Tuesday morning. In a systemic crisis, 48 hours is an eternity. The ultra-wealthy began asking a fundamental question. We can send a message across the globe in milliseconds. Yet, it takes days to settle a risk-free government bond. The system is broken. The paper trail begins in the shadows of Wall Street. JPMorgan Chase quietly launched a digital money market fund on a public blockchain with almost no media fanfare. Shortly after, BlackRock submitted filings to turn billions of dollars of its premier money market funds into digital assets. These are the absolute giants of centralized finance. They are quietly building alternative pipes to root sovereign yield. They are not doing this for novelty. They are doing it for survival. The asset behaves differently on a screen. In a traditional bank account, interest is calculated behind closed doors and deposited once a month. This new medium operates on a process called rebasing. The physical number of digital units you own increases every single day to reflect the Federal Reserve's risk-free rate. There is no waiting for a monthly statement. The middleman has been completely cut out of the spread, permanently. The skeptics are suddenly quiet. For years, traditionalists dismissed anything built on a blockchain as a speculative, volatile casino. That narrative has crumbled. Moody's Ratings issued its highest credit rating, AAAAMF. It is officially classified as carrying the exact same risk profile as cash held directly in the U.S. Treasury. The barrier between alternative digital assets and ultra-safe sovereign capital has completely dissolved. It is now institutional grade. The final clue is a matter of utility. If you own $10 million in traditional Treasury bills, they sit dormant in your brokerage account. Using them to secure a loan or back an investment requires a complex legal process that takes days. This new asset changes the rules. It can be pledged as digital collateral instantly. It can sit in an escrow protocol, earning 5% interest while simultaneously backing a secondary transaction. Your cash is working in two places at once: programmable liquidity. The pieces fall into place. This is the tokenization of real-world assets, the on-chain treasury revolution. The ultra-wealthy are no longer holding paper bank liabilities. They are holding tokenized shares of U.S. Treasury funds directly in private digital vaults. The mechanics are elegant. BlackRock holds real U.S. Treasuries in the Bank of New York Mellon. They issue a digital token on a blockchain. When the Treasuries earn yield, the token smart contract automatically issues new tokens directly to your digital address. It settles in 15 seconds. It trades 24 hours a day, 7 days a week. It is cash, upgraded. This is not a speculative bet. It is a fundamental upgrade to the plumbing of the global monetary system. The ultra-wealthy are realizing that commercial banks are an unnecessary, slow, and leveraged point of failure for cash preservation. To build long-term wealth, you must understand where your liquidity actually rests. The future of cash is no longer a balance sheet entry at a local bank. It is direct, programmable, sovereign ownership of the risk-free rate, total control. While retail investors sleep, the plumbing of global wealth is being rewired.